Okay, so thanks everyone for coming to the San Francisco Bitcoin Meetup. Clearly we're in a new space right now and we're kind of bouncing around, but I'll get to that later. First, I think Alex wants to talk a little bit about the space, just to introduce. So this is Founder Space.
Thanks, Paige. I don't think I'm going to use the microphone because I think the voice sounds very weird when it's coming out of the speakers. My name is Alex, I work with Founder Space, and I would like to welcome everyone here tonight at Founder Space for this amazing meetup that the Bitcoin community put together. Just a couple of minutes really quick about what we do at Founder Space. We run a 4-week intensive accelerator program for startups. We have amazing mentors that have been helping founders reach their goals for over 5 years, and they mentored over 100 startups. What we do here during the classes, in the time that you're enrolled in the accelerator, you get to use our space as your co-working space. So basically your small headquarters can be here for all of your team members. And our classes are very flexible, meaning that if you for some reason didn't manage to attend any of the classes during the month that you're enrolled in, you can always come back after that. We're not very strict or picky about it. If you have any questions, you can find me somewhere around here, probably drinking beer in the back. And then I'll leave you with Paige and everyone else at the Bitcoin. Thanks a lot.
Okay, so I guess we'll jump right into it with Kevin Zhou, who's the Chief Economist of Buttercoin, and he is talking on the efficiency of Bitcoin markets.
Yes. Hey guys. Hey, how's it going? It's going well. Could use a few more beers, but otherwise pretty good. Alright, hey guys, so I'm Kevin, and I'm with Buttercoin. I'm the economist there. And if you don't know Buttercoin, we're a US-based marketplace to trade Bitcoin. So we have a full order book, and I got to get the plug out of the way before we get to this good stuff. You can post bids and asks, trade on our marketplace. So if you guys are interested, feel free to check us out afterwards. So today's talk is going to be about how efficient are the Bitcoin markets, and I think it's an important topic because there's a lot of traders out there, especially in the Bitcoin space, that if the markets are efficient, then there's no point in trading, right? Then if you win, it's just lucky, and if you lose, it's just unlucky. Before we can really get to talk about that, I think we should just talk a little bit about this guy right here. So this guy, Andrey, was a mathematician in the 20th century, and he pioneered a lot of different fields of mathematics, one being algorithmic complexity. And what that basically is that, let's say you have some string, right? You got like AB 16 times, or you got this really weird, other string right here. And really the complexity of a string is sort of how easily could you describe it using an algorithm. So if our universal language that we use was the English language, then we would say, well, the first one is just AB 16 times, and it's not that complex. And the second one, well, you would actually have to say the individual characters of that string to explain what it is, basically, to reproduce it. On that line, before we get to that, on that line, I think, where I'm going with this is that, one way to look at the efficiency of the markets is just to see how random it is, whatever it means by, random. And one way to do that is to look at, all the returns in Bitcoin markets and just see, how does this compare in its complexity to, let's say, a purely random string, like a genuinely random string. So, let's talk a little bit more about Kolmogorov first. So, here's a fractal. This is the Mandelbrot set named after another very famous mathematician, also pioneered a lot of stuff. And even though it looks really complex, it can actually be replicated with a very simple algorithm. So, it may be a little bit counterintuitive what complexity really means, but what I'm trying to say is that outside of that, it's just how easily is it replicable by an algorithm. And as you can see with this thing, it's sort of like self-similar in the sense that if you zoom in to individual pieces of it, it'll just look like the whole thing, right? So to replicate it, you just have to like recurse over the same definition over and over again. So it's actually not that complex. So one last bit before we get into market efficiency. I want to talk a little bit about liberal sieve compression. So what this is it's basically a compression algorithm for strings. And without getting really into it, it compresses strings by just copying and pasting substrings. And if there's a lot of patterns in the string, then it's really easy to compress, and the compressed data becomes very small. Obviously, if it's very complex, then it's very difficult to compress, and the final output is very similar to the original input. So this is just some math. You guys don't really care about it. Don't worry about it. We could talk about how we apply this to the Bitcoin markets. So what I did, I was coding up in MATLAB a little bit in R. You take the time series of daily or hourly returns, and you can map those returns to whether that was an uptick, a downtick, or a no tick. And really this is kind of simplifying it. I mean, there could still be patterns in the market, outside of what direction it's moving. But even simplifying it, we can take a look a little bit at how efficient the markets are. So if you actually did that, you'd end up with some string filled with zeros and ones, and you can apply this compression algorithm, and you can compare the size of this to compressed, truly random data. And depending on what that ratio is, it's sort of a measure for how efficient that market is. So obviously you want to sample over multiple windows. You don't want to just do one window. So here's a couple of results from a paper that I was reading. And what they did is, they didn't look at the Bitcoin markets, but they looked at a lot of other markets. And they found that, as it turns out, the German and US markets are pretty damn efficient. It's almost indistinguishable from a complexity standpoint from random strings of up and down and neutral. And these are basically the top 10 most efficient markets out of the 26 that they've seen, that they took a look at. Here's the bottom 10. So these markets, who knows what's going on in them? I wouldn't recommend trading on them. Something awry is going on over here, but obviously the compressed string is much smaller than the input data. So it basically means that there's a lot of patterns in that data. So if you're a technical analyst, maybe you're interested in trading in some of these markets. If you do some type of algo trading, that might be a little bit more interesting. Or it just could be a bunch of insider information, and they're just making money off of everybody else, right? So there's something strange about these markets. So what about Bitcoin? So with Bitcoin, what we found is that for daily returns, the LZ index, which is from the compression algorithm return, whatever that number is, whatever it means, but relatively speaking, comparing it to the other indexes that were found for these other stock exchanges around the world, it shows that we're pretty close to the Copenhagen and Athens composite exchange in Greece. So if you don't remember what that was in the bottom 10. So it's really just not that efficient. I mean, this is we're beating out Pakistan, Sri Lanka, and Peru, right? But I mean, it's not that great. So, and then also, if you want to go down to the hourly level, it's even less efficient. And we see that Bitcoin on an hourly time frame is even less efficient than the very bottom, which is the Colombo Stock Exchange, which means that either there's given that there's no insider trading in Bitcoin, probably very little. There's probably a lot of opportunity to develop algorithms or trading strategies to generate positive returns. Go ahead.
Can you define what you mean by efficient in this context?
By efficient, I only mean according to this measure, which is that from looking at the returns of the Bitcoin markets and comparing them to returns that would truly be random. Right? So like if you just took a truly random string and you compared that to the string that was represented, that was mapped from the Bitcoin returns, like how do they compare in terms of their compressibility? Yeah, go ahead.
Yeah, I was just going to add that I think you're assuming that if there are no arbitrage opportunities, then it's completely random. But if it's not completely random, then there are arbitrage opportunities, and that means that, and like it's like basically we say a market is efficient if there are no arbitrage opportunities. Right?
Yeah, I wouldn't say that's the case. I think a market's efficient if you can't predict the future based on past historical data.
Okay.
So there doesn't need to be arbitrage opportunities for you to do that. Like let's say like the market always follows like a U pattern over and over again.
Mm-hmm.
Like even if there were no arbitrage opportunities, you would still be able to say that, hey, it's at the bottom of the U, it's probably going to go up next, right?
So does that mean that, how does that have to do with efficiency?
Right, so what I'm saying is that as long as you can't predict future prices based on historic data,
Okay.
then the market's efficient, right? And otherwise, it's not very efficient. And we're using a proxy here of the compressibility of those returns mapped onto, using the LZ algorithm. So there's a couple caveats here. First of all, with Bitcoin data, there's not that many days to sample from. So obviously, this might not be statistically significant, even though, it suggests something. So obviously, as time goes on, we'll have more data. We'll be able to see, with more certainty that this was the case. There's also the question of whether or not we should use a binary or ternary alphabet, as in, should we say that, there's only upticks and downticks, or are they, upticks, downticks, and zero ticks? Outside of that, there's the choice of the compression algorithm. I chose the LZ algorithm, but Kolmogorov complexity itself is a very abstract concept. It's basically what's the shortest algorithm necessary to replicate a string, but how would you ever be able to tell what that was, right? So you have to kind of proxy it with some type of practical algorithm to compress that string. The other thing is that Bitcoin markets really evolve really quickly. So even just like a year ago, it was probably a lot less efficient than it is today. So, that's just something to keep in mind. I think that, things have improved quite a bit. I've taken a look at some other signals, and, I think using a support vector machine just even 6 months ago, I was getting 66% accuracy out of sample on upticks versus downticks. But now, I think just 2 months ago I was testing that again, and out of sample accuracy was down about 60%. So, I think the Bitcoin markets, as more people move into it, as it gets more liquid, it just gets more efficient overall. The other thing is that efficiency may vary across different exchanges. So, if you look at Bitfinex versus, Bitstamp, might be different. Chinese exchanges are probably very different, but who knows really. So, just a couple things to keep in mind. And, so now that, we're somewhat convinced that the Bitcoin markets are not very efficient, even for fairly long time frames, how do we go about actually making predictions on where the price is going to move next? Like if it was actually inefficient, then there should be some way to generate excess returns, right? Well, there's actually a number of ways to do that. No, I'm just kidding. There's some references if you guys are interested. If not, it's cool. Go ahead.
Question. What motivation between introducing like the overall complexity into this whole argument? Why not use just traditional statistical methods as people do in finance?
What sort of statistical methods do you have to measure market efficiency?
Well, essentially, we're trying to measure randomness here.
That's
and
right.
overall complexity is about the length of an algorithm to generate the particular sequence.
Right, that's right.
So
So what I'm saying is if you take the time series of return data, then if it were truly random, it should have the same complexity on average as a truly random string, right?
okay.
So this would be some way to measure efficiency, right? Like how else would you measure it, right? Like you could use statistical models to sort of predict based on historic data where the price is going to go, but how about overall market efficiency, like that concept of efficiency? How would you go about measuring that? Yeah, go ahead.
Well, actually, that I want to do a riff on his question. So, did you guys ever look at like KS tests to like test the hypothesis that it's like just following Black-Scholes or whatever? I don't think that it doesn't look like it does.
Sure. So Black-Scholes is for options pricing. It's
Okay.
not. It's not really about the underlying.
But you can do it for daily returns, like logarithmic returns. You can like model like the logarithmic return of a
No,
stock.
Black-Scholes is an options pricing formula. That's
No.
not correct.
Okay, I'll talk to you offline about it.
Okay. Actually, my background's kind of in options pricing, so.
But then when- so-
you know, so I got to say a couple things here. First is that Black-Scholes is for options pricing, and the second thing is that Black-Scholes isn't really that good.
Yeah, it's not good.
So, great. Go ahead.
Did you guys have any other compression algorithms? Yeah, the results compares what you got now.
No, that's what we should do. Yeah.
Okay.
Yeah, you're right. Yeah. Go ahead.
I was curious as to which exchanges you were looking at to generate your measures of efficiency.
I was looking at Bitfinex and Bitstamp, but we should look at more exchanges.
Yeah, so I'm a complete noob to Bitcoin, so if these are dumb questions, I apologize, but I do know options pricing.
Sure.
In the caveat section, would you include bid offer and the inability to short as caveats in terms of taking advantage of the inconsistencies of the time?
Oh yeah, to take advantage of them, yeah, you definitely take them into consideration, just like exchange fees and other frictions, right? Like even like withdrawing and depositing, if that's significant, then you should, think about that. Yeah.
You may have mentioned this, I apologize if you did, but so there's a duration, right? An hour or a day
Sure.
or a minute.
Uh-huh.
I'm guessing that with different durations, your outcome or your result would be quite different.
Yep.
And so then how do you determine what duration to go with?
Well, really, it tells you a couple different things, right? So, are daily returns efficient or inefficient? Are hourly returns inefficient or efficient? And then so on. From what we've found, the lower that you go in, the higher that you go in frequency, the more inefficient it gets. So, obviously, for very long time frames, it's probably pretty efficient. I mean, that's to say from, the past historic data sense. Obviously, fundamental news can obviously change things, right? Like if the US government all of a sudden says that Bitcoin is the reserve currency of the world now, we're adopting it, well, that's going to move the price outside of, analyzing historic data. Yeah. Go ahead.
Have you looked at higher frequency, 5 minutes, 1 minute?
That's for you guys to do.
I'm sure you have.
I'd imagine it'd be a lot less efficient. Yeah. Go ahead.
Yeah, I was thinking that if you were looking to actually take compressibility and turn it directly into a trading strategy, you could just reverse engineer what the LZ algorithm is doing, right? If it says it's compressible in this way using this dictionary, can't you just turn that around and turn that into a trading strategy or not?
No, this isn't really a trading strategy. This is really to see if it even makes sense to have trading strategies. Because if the market's efficient, then, not trading strategies altogether, but just like trading strategies based on historic data. So things like technical analysis or algorithmic trading, like does that even make sense in the first place? And from what it seems like, there is something there.
Sure, I can see how we can use that as a measure of market efficiency, but taking your example of the 32-character string, if the LZ algorithm is describing it as, AB repeated 16 times, can't you then turn that around and say, okay, I'm going to use that as a predictor, and predict the next 2 characters are going to be AB?
Maybe, I'd have to think about that, maybe. That's possible, maybe. Yeah, go ahead.
How far back in the data did you go? I would assume the market was somewhat different 2 or 3 years ago than it is now. So, you have kind of a tension between the sample size and the market changing over time.
Right, no, I completely agree. I think more recent data is probably more relevant, and I think that, it's probably more efficient than the time frame that I use. I use a very big time frame. Yeah. So like going back like maybe a year and a half. Yeah.
Oh.
Yeah. Yeah. Go ahead.
Is there a reason you compared equity indices to Bitcoin rather than currencies?
Well, yeah. I think the original paper was done on that.
Okay.
And I was trying to replicate some of that for Bitcoin, and see if there was any idiosyncrasies to Bitcoin to keep blind of.
Have you compared other currencies by any chance?
Oh, I haven't. No, I haven't. Oh, you guys got a lot of work to do. All right, cool.
In
Any comment on what's causing the inefficiencies?
It could be a whole number of things. I mean, I don't know. I mean, probably, I know it's about as much as you guys probably on what causes it. But I think it's just good to, sort of take a look at it. And because, sometimes I'm, having all these trading strategies, I think to myself, am I just getting lucky or am I actually doing something valuable, right? Because there's always some type of survivorship bias, right? Like out of like 1,000 people, 10 of them are going to be right 10 times in a row, right? Something like that, right? So it's like, am I just one of the lucky people, or is there like actually something to be made here? And I think, from this, it helps me believe that more, that there is something there. All right, cool, awesome. If you guys want to talk about it afterwards, like I'm here.
My question was late.
Hey, no problem.
So we're gonna try without the mics because it's a little muffled. So I think if everyone can hear me, then we should be okay. Okay. So this is Matt Corallo. He's with Blockstream, co-founder of Blockstream, and he's talking about economic incentive-based consensus. Good?
Yeah.
Okay. All right.
All right. I hope everyone can hear me. I try to project. People in the back, good? All right. Awesome. So, as mentioned, I'm Matt. I work for Blockstream. I'm a co-founder there. I've been doing Bitcoin Core development and Bitcoin J stuff for 4 or 5 years now, something like that. And I really got into Bitcoin because it was kind of this merging of my interest in both this like economic and kind of almost macroeconomic incentive structures, which is kind of macroeconomics, right? But also computer science and programming and distributed systems, which is really interesting. So this talk largely focuses on how these incentive structures work in Bitcoin, briefly touches some alternative systems, and yeah. So it is going to get a tiny bit technical, hopefully not too technical. Let's start off with how many people in this room think that they know how consensus works in Bitcoin? Think they know what consensus is in Bitcoin, how it works, if they're comfortable with the security assumptions in it? Okay. Hopefully I can answer can teach a few things, but we'll see. So yeah, there is, for those who have done much computer science study, are familiar that there is a long history of distributed consensus in computer science. And first of all, I want to start by saying that it is a very different type of distributed consensus in computer science. Kind of for 2 really important reasons and some other reasons, but mostly because, one, the traditional distributed consensus model that you see in computer science is I have 3,000 servers in a data center and I don't want to rely on any one or all of them being online all the time because half of them fail every day and like that's normal. And I still want to be able to like access my database, and my database should be consistent and it shouldn't fall over, and like I shouldn't lose data arbitrarily, and I should be able to form some kind of shared opinion. All the computers should be able to work together and come up with an answer together as to what the status of the database is, what order they should run updates, what order they should reboot, whatever it is, whatever problem it is you want all the computers to have the same answer to some question. You want to use some distributed consensus mechanism. In Bitcoin, the answer to the question is in what order did these transactions happen, and thus what's a double spend, or what is the canonical transaction that is confirmed? What is a double spend? But the traditional distributed consensus mechanism that you see, that is, I have however many servers, really focuses on, we have pre-enrolled servers. So we have, we start with 5,000 servers, we know the 5,000 servers, we can list the 5,000 servers, all the 5,000 servers know each other, we know the IP block, their IP addresses for all of them. Bitcoin does not have this at all, obviously, right? Nodes come up and go down all the time. I open my wallet on my phone and I've got a new node that's now a member of this distributed consensus, and then I close it and now it's not a member of the distributed consensus. So we really don't have this concept of enrollment, which has been the focus of academic distributed consensus for a long time. And the second important point, which is kind of related, is that academic distributed consensus, or traditional distributed consensus, has this generally does not concern itself with what happens if someone comes along after the fact and wants to figure out what the consensus was, right? So these 5,000 servers, they came up with a consensus and they decided that the database's contents are this, and now someone else comes along and half of these servers have failed and new ones have come along and whatever, and they want to figure out what the consensus was, and they want to have some kind of auditability, they want to have some kind of proof that this is what the consensus that these original 5,000 picked was. And that's generally not something that is particularly important in kind of a traditional academic study of distributed consensus, but it's critical for Bitcoin, right? I can still open up my Bitcoin core node and figure out what the consensus was back when Satoshi was the only miner. So Bitcoin works in a very different way, obviously, and instead of relying on enrollment, it relies on two things. So first is Hashcash. So it relies on Hashcash to create an identity list, decentralized global rate limit. That is complicated and confusing. So Bitcoin obviously does not rely on identity for mining. You don't have to go register your IP address. It's not on a list, whatever. So it's just, you plug in a machine that has an ASIC or had a CPU back in Satoshi's days, and you just start mining. And importantly, we use the Hashcash algorithm, which is the algorithm that all these ASICs are working on when they're mining Bitcoin. They're just spinning and spinning until they find a solution that happens to meet some target in the hash function. And by making it difficult to do Hashcash, we can come up with some global rate limit. So there is a global rate limit. On average, we get 1 block every 10 minutes. And that is enforced by the system, and that's practically mathematically enforced. Like, you can't, if you plug in a bunch of new ASICs, yeah, maybe the network will speed up for a minute, but then we'll be back to 10 minutes on average, or 10 minutes on average per block. Or if you unplug a bunch of ASICs, yeah, it'll slow down for a bit, but then we'll be back to 10 minutes on average per block. And the whole system is rate limited. So that's not enough to create consensus. So let's say we have a blockchain that looks like this, right? What encourages miners to build block A and not block B, right? If half the miners were building A and half the miners were building B, then it would be incredibly difficult for anyone who's a member of the network, BitPay, Coinbase, whoever, to look at this and say, well, crap, I have a transaction that's in this block, and I have a transaction that's in this block, but which one should I listen to? Because they conflict, and it's really not clear whether B is going to get built, and then maybe a C is going to get built that builds on B, and then like all of a sudden, the transaction that looked like it was ahead, it's no longer the consensus, and now I've gotten double spent, right? So if we have a picture like this, we absolutely need to have miners building block A and continuing the longer fork so that everyone can look at this and say, okay, this fork is longer, we know that this is probably going to be where we go long term, and we can trust that even though we have these random blocks out here, they don't actually matter. So Bitcoin does this for kind of two ways that go hand in hand. So there is an opportunity cost to building B. If you are a miner and you focus here and you build this B block that's actually not going to end up in the consensus, you've just spent a bunch of power, and you would have otherwise gotten some freshly minted Bitcoins by mining A, right? You would have gotten the transaction fees and the mining subsidy, the block reward for the miners. And if you built A, you would have gotten that. If you build B, and then the rest of the network is honest and goes on and build A and builds out on here, then you don't get anything. You're host. So there's a very strong opportunity cost in the form of 25 bitcoins or however many bitcoins to not building B. So you really want to build the thing that is going to be a part of the consensus in the future. And in addition to that, it's also important that there's a direct cost, right? So that it's not free to go off and build B. Otherwise, I would just be blindly attacking Bitcoin because whatever, it's for the lulz, right? I just want to break things. But there's a very direct power cost to building B, right? I have to go pay $3,000 a month in power in ASICs to build any block in Bitcoin. So not only am I going to spend a bunch of money to attack the system, but I'm not going to get anything in return because my block's just going to be orphaned and whatever, which sucks. So the security of model of Bitcoin really is that we have is that it is, for an individual, if you're not colluding with 50% of the mining power, it is rational for you to build on A because there's an opportunity cost to not doing so and it costs you money to not do so. So very directly, as long as we don't have 50% mining pools or a lot of collusion in the network, it is economically or game theoretically rational for individuals to be building on the best network and to, quote unquote, encourage consensus, which is to say, encourage, continue building on the chain that will give them the best chance at consensus, which is the longest one. So it's also important to note, there's a lot of other systems around. You hear about a lot of different things that are proposed as alternatives to Bitcoin that work in very different ways, or fairly similar ways. But though Bitcoin relies on the majority not colluding and then is otherwise rational actions of individuals will build consensus, many of the others are not at all the same. So you have a lot of different models in this space that people are proposing, and frankly, not a lot of discussion about what the different security models are, right? It's perfectly legitimate to go trust Wells Fargo and FDIC with your money. I do it all the time. It's a perfectly legitimate trust model. It's just not the one we have in Bitcoin. The one we have in Bitcoin is a very careful trust model where you don't have to trust anyone except for a few small facts of like the majority is not colluding, which is a pretty big leap of faith, but it's not just blindly trust one individual. And so we have things like the Stellar Ripple model, which is we're trusting some group of nodes who are providing consensus. In Stellar, I think that's currently one node. Sorry, Stellar, if there's anyone from Stellar here. I know they're working on it. They're replacing that. They're replacing that. And the proof of stake stuff tries to rely on trusting an economic majority, so it trusts whoever holds 50% of the coins or whatever. It tries to trust them with your consensus and with the ability to double spend and the ability to kind of attack the network and make it fall apart. It's important in these two models to know it's rational for an individual, for the people who are running consensus to build consensus and not fork the network or split the network or whatever, because there's money to be made if you attack the network sometimes, right? If you double spend, you can make money. If you, even in a Bitcoin model, if you can attack the network and build out this fork, and this fork dies, you can potentially get just more block rewards, right? You don't even have to double spend to necessarily make money by attacking this kind of network. So in all of these systems, it's important to think about, is it even right? Like, is the person I'm trusting with consensus and with my money and with this system, do they even have to act irrationally to attack the system? In the kind of economic, game theoretic sense of rationality of like optimizing for profits. So anyway, so that the Bitcoin model, you can get a bit into kind of stuff we build on top of Bitcoin, and I'm focusing on the Bitcoin model because the others largely are nowhere near as trustless as Bitcoin is. There just hasn't been really any proposals that have the same security model in a lot of ways, and by far most of them are a much more trusting security model of trusting a different group or trusting a larger group. So in any system that is kind of Bitcoin style, where you have a blockchain and you're doing whatever you want with it, you still need these two things that we had in Bitcoin. Remember, we had this hash cache, which was creating our decentralized rate limiting, that you have a global rate limiting of the number of blocks, which is kind of required for speed of light and basic physical reasons. And then we also have this cost of attacking the network and cost of attacking consensus, or building against consensus, in the form of this opportunity and a direct cost to doing so. So in a system where we're building a blockchain for whatever purpose, we still have to provide very similar things if we want to use a similar Bitcoin-style model, where we still have to have this decentralized rate limiting. Now that one, it's pretty easy to get that, right? We can get a decentralized rate limiting by doing a kind of merged mining scheme, which is where you can put your mining power in to both Bitcoin and a separate blockchain with no additional overhead, no additional cost for you. This is what Namecoin does. This is what I think Dogecoin does that now too. There's a bunch of systems that do this. But the cost to attack part is much harder, right? So if you're spinning up a blockchain and your goal is to use it for, I don't know, you want to put a blockchain in a blockchain because why not, right? Then you have to somehow create an incentive. You have to create an incentive that could be by paying miners directly, the same way Bitcoin does, or by, you could do like a Namecoin kind of system where, you want to use the system to purchase your domain name. You want to use the system to purchase whatever namespace you have. Those fees go to securing the network. They go to securing your system by creating this cost to attacking the network. And it's also important to note that this is the exact same problem with sidechains, right? Sidechains aren't magic. They're just another blockchain that happens to have a transfer mechanism between Bitcoin and the sidechain so that you can use the Bitcoin token on the sidechain, but you still have to provide this same incentive structure. You still have to be able to incentivize miners to not actively attack your sidechain. So, you can incentivize by whatever you want, whether it's directly by money or be creative. You can send them hand-drawn pictures of cats if they happen to mine blocks that are part of the chain. Be creative, right? If it incentivizes people, then it incentivizes people. But, yeah. So anyway. Do we have questions? There's no way anyone understood my ramblings. Like, I didn't even understand it. I mean, come on. Sure.
So, occasionally, Ghash has 51% of the hashing power in Bitcoin. So, how are we not trusting them? Well, we just trust them. We trust them to follow them.
We largely are. It falls to a kind of similar trust model that you have in a lot of other coins that you see, which is
coins, right? Like that.
It's not as bad as proof of stake, but it's still as bad as some other systems, which is largely that you are trusting that they don't want to destroy the value of the coin, right? If they actively attack the coin, they don't necessarily need to double spend, but it is going to be visible that they're actively forking the network, and potentially that has a very negative impact on the value of Bitcoin. Yeah, it's not as severe as like trusting the history of all owners of coins, but you are still trusting that that Ghash, who has a large investment in Bitcoin ASICs, doesn't want to destroy the value of both their investment and the coin. But yeah, it is kind of a failure of the Bitcoin trust model. Hopefully it plays out better in the future, but who knows? None of these systems are great, anyway.
I'm curious about whether you have opinions on the zero coin, zero cash proposal that's been floated, and I don't know myself, but does it have a different sort of enforcement method or incentive structure than the main Bitcoin one does?
No, actually, it's fairly similar in terms of the incentive structures. Zero coin, for those who aren't familiar, Zero Coin and Zero Cash are two fairly closely related proposals. Zero Coin was an earlier one that was fairly computationally expensive and doesn't scale particularly well. Zero Cash also doesn't scale hugely well, but is much better. It does, however, require, I think the biggest difference in terms of the incentive structures in it is really the trusted setup phase. So Zero Coin is not, but Zero Cash requires a trusted setup, which is where you have some group of people all perform this operation, where the result is a public-private key pair, and then they publish the public key, and you have to trust that they all throw away the private keys. If they don't throw away the private keys, or you have to trust that at least one of the set of people threw away the private key. If they don't, then they can all get together and print money without you being able to identify it, and yeah, they can just print money and you can't notice. It's impossible to tell. So it's kind of a different trust model, but cool tech.
So help us understand sidechains, since you obviously I have questions, I'm not crying. I mean, are all these hundreds of coins that you would expect to come out of these sidechains to be based on like own mining networks where it's all proof of work? I mean, I read your paper, that all sounds wonderful, but help us understand some of the mechanics and how mining is going to either be an enabler, an inhibitor, or just how it fits in with all these sidechains and the coins and sidechains.
Yeah, so I mean, sidechains, really it's important to understand that sidechains aren't any different in terms of like the incentive structures and stuff than Bitcoin, right? You still have to have the same mining systems, the same incentive structures as Bitcoin. The mining systems, of course, you can do merge mining, which essentially the difference to a miner is like, okay, you plug in one more Raspberry Pi in your farm of 1 million ASICs, and that adds mining for whatever sidechain. Yeah, so I mean, I guess I'm not entirely clear on the question, but like the merge mining stuff, yeah, that's pretty easy to deal with the mining part, right? You merge mine, and then you still have to have an incentive for people to not actively attack the network, right? Because with merge mining, it becomes free to attack the network because you're already mining Bitcoin. So you have to have the same kind of, whether it's a block reward system by taking fees, or whether it's like a Namecoin kind of system where you're buying domain names, and as a part of buying the domain name, you're like paying into the security of the network, or whether I'm sitting there hand drawing pictures of cats, like stick figures, and mailing them to people who are mining. In any way, somehow you have to incentivize the miners, no different than Bitcoin does.
Well, the question is just how much the infrastructure changes when we have one Bitcoin network versus one Bitcoin network.
I mean, it does and it doesn't, right? So the infrastructure for mining certainly marginally changes. The infrastructure for other systems, the infrastructure for other systems, say like a Coinbase or a BitPay kind of system, doesn't change at all unless you want to actively accept Bitcoin on a given sidechain, right? On a given sidechain, you would need to also run whatever server or software daemon for that sidechain, the same way you would run a Bitcoin daemon for Bitcoin, and you would also have to treat it like any other Bitcoin. So a transaction you receive on it, you'd have to treat the same way as you would receive a transaction on Bitcoin.
Where are blockchains a bad idea?
Well, doesn't actually. Right. It is a terrible idea to put a blockchain in a blockchain. That doesn't actually make sense for those who are wondering. So blockchains are generally a terrible idea for a lot of things. I'm not going to try to go into detail about like where they're all a terrible idea. Certainly there's been a lot of focus on like, well, we can do all of our computing in the world and we can replace AWS with a blockchain, and it doesn't really work that way at all. That doesn't make sense. There's been a lot of like, well, we can just put the whole internet in a blockchain, and then like all of the web pages are in a blockchain, and they're always there, and they're always accessible, and you can see the whole history. It's like, no, it doesn't scale, please. Like, blockchains do not scale very far. They scale wonderfully for like, I don't know if people were at the talk last night at the Bitcoin Devs Meetup, but there was a great talk on like how you take a Bitcoin-like system and build trustless transactions on top of it without even having to put them in the chain. And these kinds of systems are great. Like, blockchains provide a very useful foundation, and they don't scale very far beyond that. And they also don't. It's hard because there's so many people who like put out proposals that don't include a lot of this kind of incentive structures, and they're just very insecure, right? It's free to attack them, and there's no cost to attack them. So like, why am I not attacking them for the lulz? I have better things to do, but there are other people who will as soon as they get big. So yeah, I know that didn't answer your question at all, but if anyone has specific questions, I'd love to take them.
It wasn't clear from white paper how you are going to freeze coins on the main chain while they're doing something on the side chain.
So there's two models, right? There's the federated peg model, which I believe was in an appendix, and is kind of the stopgap model to the full soft forked Bitcoin model of the sidechain. In the federated model, the freezing is just a simple transaction to send money to the federation. So it's a simple multi-sig transaction. It sends money to a multi-sig via P2SH or whatever. And that multi-sig is the federation, which is responsible for returning money as it comes back from the sidechain. In the full soft forked Bitcoin model, the way you freeze money is you send money to a specific transaction output format. I don't know if you're familiar that all Bitcoin transaction outputs are programs, they're scripts. They're not just like here's a public key. No, it's actually a full program that says, please provide a signature for this public key. And that program, in this case, is one that says, if you provide a proof that the money was declared to be returned on the sidechain, then you can spend this. Otherwise, this is just a transaction.
Okay, so regarding federation, it means that some node should do a final signature to release the money, right? So
yes.
How it will be determined?
So this is kind of a generic model for doing like testing a soft fork in Bitcoin, where if there's something that you want to do, you can replace this execution of the script directly in the Bitcoin network with execution of the script by an oracle. And then you just send money to the oracle, and the oracle is responsible for executing the script the same way the Bitcoin network otherwise would, and then releasing the money if that script passes.
Then an entire sidechain will depend on a single oracle.
An oracle or a group, in this case it would be a group of people who are responsible.
It means that you have to copy a private key.
No, you don't copy a private key. They each have their own private keys, and it's the same as a Bitcoin multi-signature thing, where it's like n of n. So you'd have 5 out of the 7 of them have to agree to spend the money. Yes, it's obviously a very drastically reduced security model, and it's really just a testing and kind of stopgap measure to like, hey, look, we can test this thing, we can show that it works, and then we can upgrade to kind of the full security model.
One more question.
Okay.
What's your opinion on the scalability debate? And if you could wave a magic wand to scale Bitcoin, how would you do it?
Wow, you're a dick. It's a terrible question. Okay. So the scalability question of Bitcoin is really hard, right? Bitcoin, a blockchain system doesn't scale particularly far by itself. Again, the talk last night was pretty awesome. For those who missed it, I think it'll be online at some point. And people should watch that, where there's a lot of ways where we can take Bitcoin and use it as a primitive and use it as a low-level tech and then build very scalable systems on top of it, which have drastically reduced trust from, say, the current financial system, but maybe marginally increased trust from Bitcoin itself, where Bitcoin is, I'm not trusting anyone except for miners, I'm trusting the miners. And like, I'm putting this transaction and I'm not trusting anyone with it. And you can build some stuff on top of it where like, well, I'm not trusting you to steal my money, but maybe you can like lock up my money for a few days and I won't be able to get at it, but then I'll get it back. And you can build systems like this in Bitcoin that have drastically much huger scaling. Now I don't want to say, I'm not gonna speak for or against block size increases because that's a very complicated subject. But certainly, putting all of the transactions in the blockchain is never going to scale. The number of transactions in Bitcoin today that you see on exchanges and you see within Coinbase and you see between Coinbase and BitPay and whatever else are already very, very large and potentially larger than a blockchain would ever scale to. So we can't just increasing the block size is not a magic bullet. It would have to be increased so drastically that the whole system would become a centralized system, and that's not okay, obviously. So sure, maybe block size needs to be increased, maybe it doesn't, maybe we need more room in the blocks, maybe we don't. I'm not going to try to answer that, but certainly we should be looking at building systems on top of Bitcoin that scale better than Bitcoin itself. Yeah.
Cool.
Okay.
Packing up. I'm just going to give a few announcements before we jump into the lightning talks. So if you did sign up for a lightning talk, or if you are someone that wants to, we still have a couple of spaces left that we could add you to. So just kind of come over here if you put your name on the list. But I really wanted to announce that we're doing a collaboration with EFF and Internet Archive this Thursday for the FCC Title II reclassification. And
net neutrality, go!
Yeah, so we're celebrating net neutrality with the Internet Archive and the EFF on Thursday at the Internet Archive, where we held our meetup last month, which is 30 Funston Avenue. And I'm really excited about kind of collaborating with these groups. It's the Bitcoin community could really benefit and vice versa from talking with people that are really interested in privacy, personal privacy, and it's going to be a party, so we might as well hang out together. So that's going to be this Thursday at the Internet Archive, which is in the Richmond district, 300 Funston. I made that a meetup event itself, so if you don't remember that, you can just look on the meetup. And also for that, if you are available to help by any chance, that we could use a couple extra hands for just serving the beverages and cleaning up food and stuff. So if you actually want to help, show up a little early at the Internet Archive with me. At 6 on Thursday, just come find me tonight and give me your email, because it would be really cool to find at least 2 more people that would want to assist in helping. And so obviously we're not at Geekdom right now, and we're probably not going to be, because they don't really want to do monthly events anymore. So I don't think it was us specifically. I think they were just kind of changing their model for doing events. But that means we're kind of in the market for potentially a reoccurring a venue that we can use on a reoccurring basis. And actually, a question that Elizabeth asked me last night was, why don't we have a Bitcoin space in San Francisco? Does anyone want to take that on? That needs to happen. So collaborate. And if anyone has any ideas that they want to talk to me about, I'm more than willing to listen, because there's a lot of us in San Francisco, and I think we would all really benefit from some sort of space that would, where we could hold meetups and just gather as community and have startups present out of and whatever. So keep that in mind, or talk to me if you have any ideas, or if you have any ideas for temporary spaces that we could use in the meantime. So we're open to that.
And finally, just thanks to Coinbase for sponsoring as always, and particularly also Ryan Taylor, who does the live stream. We're also live streaming right now. I kind of forgot to announce that at the beginning, but as always, we're live streaming, so that's a cool thing that not many other Bitcoin meetups have. So yeah, so let's do the lightning talks. So lightning talk people, we're gonna open up your website.
I'd like to
Does anyone need a mic, or can you yell? Let's yell. Are you Jay?
Yep.
Okay. This is Bitseed.org.
Well, it doesn't.
Yeah, just add your name to here and all that. Or, yeah, I don't know. You can go ahead and just start talking before other people start walking away. All right, everyone, let's listen to the lightning talks. There's 10 of them, just a minute long each.
Okay. Hi, I'm Jay Feldis from Bitseed. We're developing a little thing we call a Bitcoin blockchain box. It's a little server, has a dual-core ARM processor, gigabyte RAM, 160 gig hard drive, and we have them hosted and running full Bitcoin blockchain nodes. So that could be useful if either you just want to run a node to support the network, or if you've got an application that can build on that. It can run pretty much any other type of blockchain node that we're aware of. So it can run Namecoin, it could run a DNS server on Namecoin. There's a lot of potential uses for it. So it will sell for about $99. We've got units available now for people who want to develop on it. We're interested in people who want to, they might see a good opportunity to develop a low-cost product that could go on this hardware. All right, Bitseed.org. Thank you.
For the record, Ghash only has like 20% hashing power right now. My name is John Light. I work with a nonprofit called the okTurtles Foundation, and our mission is supporting beneficial decentralized technologies. We have some educational materials on our website, okturtles.org, and we're also working on a few open source projects that utilize blockchain technology. We have DNS Chain, which is disintermediating and replacing certificate authorities with the blockchain. We have Blockchain ID, which is basically a decentralized replacement for like Facebook login, OAuth, and systems like that. And the okTurtles browser extension, which uses DNS Chain to enable end-to-end, man-in-the-middle proof communications across pretty much any website. It's like just a cool little chat application that works in the browser. You can learn more about everything we're working on, okturtles.org.
Thomas?
Yep. So I'm Thomas, I'm a co-founder of Ledger Wallet. So at Ledger, we're basically bringing the smart card security standard to the Bitcoin world. So smart cards have been great to secure secrets, to secure a credit card transaction for many years, except in the US. And we're basically bringing that level of security to the Bitcoin world. So our first product is the Ledger Wallet Nano. So it's a hardware wallet based on physical secure elements. So it's a secure microcontroller. So this one is a USB form factor that you just plug into the USB port. And on the browser, you just have public information. And everything that is private, everything dealing with the seed derivation of seed signature of the transaction is made on the secure element. So we just got funded last week, and we've got a nice product roadmap with a mobile phone integration, and we're also pushing some white label integration for third-party wallets. So if you're just interested in, as an end user, as a developer, just ping me, and I'll be glad to talk to you. Thanks.
Reuben?
Hi everyone, I'm Reuben Bramanathan. I'm a Bitcoin lawyer from Sydney, Australia. My firm, Adroit Lawyers, works with a bunch of Bitcoin companies around Australia. We've also been involved with lobbying the government in Australia at a number of levels to try and get some regulatory clarity, certainty, get things right. I also host the Sydney Bitcoin Meetup. I'm just visiting here and I've just come to check it out, so thank you for having me. It's an interesting time in Bitcoin in Australia. We have a Senate inquiry ongoing. The results will be released next month, so it's an interesting perspective on a Bitcoin ecosystem. So watch this space and come say hi if you'd like to learn anything about Australia and Bitcoin in Australia. Thanks.
What's your offer?
Adroit lawyers.
Hi everyone, I'm Ryan Taylor from Blocktech. Alexandria is a new set of protocols that defines a relationship between a number of distributed networks. Each are used to provide various features for the front-end services. The network will be able to stream HD video and lossless FLAC audio, and when a piece of media is especially popular, rather than needing to buffer, speeds will actually be bolstered. For artists, publishing and distribution fees will be minimal or non-existent. Artists will be able to control how they choose to distribute their content and how they wish to monetize it. Options will range from free with tips to pay per stream and everything in between. We are constantly working to add new media types to the content submission mechanism and implementing new cutting-edge distributed networking technologies. Alexandria currently supports movies, music, videos, podcasts, books, 3D printables, and recipes. In the same way that Bitcoin allows people to be their own banks, Alexandria allows you to be your own publisher. Find out more at blocktech.com.
Hey guys, I'm Eric with BitPay, and I'm here to talk to you about open source and Bitcore. Over the past few months, we've really been putting a lot of energy into polishing up this open source framework that we built called Bitcore. It is an isomorphic JavaScript library, meaning that if you write your code, it will run in a browser, it'll run on a server, it'll run everywhere that JavaScript runs. It is fast, it passes all of the tests that Bitcoin Core tests, that Bitcoin Core has it, and we've also built a plugin architecture. In particular, the one I'm most excited about is Bitcore Channel. This is a full end-to-end implementation of Bitcoin payment channels, which if you're not familiar with are a way of aggregating large amounts, high volumes of very small value transactions and only broadcasting one onto the network. We're really excited about seeing APIs monetizing through this, charging per API call, charging per kilobyte of data. So that's bitcore.io. Looking forward to see what you guys build.
Hello everyone, my name is Paul Puey. I'm co-founder of Airbitz, and we have launched an iOS and Android mobile wallet with a really core focus on delivering an open source solution with a decentralized wallet that's as familiar and easy to use as mobile banking. We've already launched it. What we're looking for is actually anyone who's interested in doing a user experience test with us. So we're here being accelerated through plug and play in Sunnyvale, but want to connect with anyone that wants maybe an exchange of about 100 millibits to spend maybe half an hour to 60 minutes with us and give us feedback on the product, both in iOS and Android. And you can already download it today and give it a try and give us some feedback. We'd love to sit down in more detail with some people that really want a wallet that, once again, is familiar and easy to use once Bitcoin really does become a good portion of our economy. So come reach out, look for this shirt. There's 4 of us in our team, and we'd love to chat. Thanks.
Yeah! Woo! Woo! Okay. Hi, my name is Andrey. During last 5 years, I've been involved in approximately 10 Bitcoin companies, and currently my product is about, it's a white label solution for people who would like to build some custom type of asset like currency licenses or shares or whatever on top of blockchain or Blockstream or application like this. So it's a white label solution for issuances of custom properties on top of the blockchain. Talk to me.
Hey guys, I didn't expect to speak, so I'm kind of winging it.
My name is Max. I'm representing the Bitcoin Association at Berkeley. I have two club members with me here. Last November, we put on something called the Baybit Hack, which was the first ever collegiate Bitcoin hackathon. We had a number of sponsors there. So we're just now laying down the groundwork for the next Baybit Hack, which is probably going to be sometime very early May or late April. So if you're interested in sponsoring and getting access to developers to hack on your service or for some recruitment opportunities, talk to me and I'll definitely hook you up. All right.
Or talk to Kelly for me.
Hi guys, I'm Evelyn from Coinplug. Coinplug is one of the biggest exchange and ATM and prepaid Bitcoin card service from South Korea. We started our service only about a year ago. We're a team of 16 people. We're all from Cisco Systems, former Cisco Systems employees in Korea. I came here today to experience Meetup here. There are only about 20 people gathering in Seoul Bitcoin Meetup, which is held on weekly basis. I represent Coinplug and I'm here to look for a company who is interested in doing remittance service in Korean won to US dollars. So if you guys have any suggestions, we also have all sorts of open API for iOS, Android, and prepaid Bitcoin card service. And we have trouble expanding Bitcoin industry within Korea, so we took another turn. Instead of doing B2C, we decided to go B2B. So we are working with one of the biggest ATM company in the country to turn 7,000 ATMs into Bitcoin ATMs throughout the entire country. Thank you.
All right, that's it. Have fun with beer and